Chris Conway from the Australian Stock Report is joining us live from our Melbourne studio. Chris, wonderful to see you there. Thanks very much for joining us. Now, only a couple of weeks ago, we were talking with you about your year-end target being 5,700, and it certainly looks like it's well within reach now.
Good afternoon, Leanne. Yes, look, it's wonderful to see, isn't it, the rally that we've seen over the past couple of weeks. Indeed, you asked me a couple of weeks ago what my year-end target would be. 5,700 was my response. Looks like we'll almost certainly get there, or at least very close. And now the question really begs is, can the momentum continue into next year? I think that's the next question on everyone's mind.
And do you think it will? I mean, history obviously tells us that the back end of December typically is strong, and it looks like it's no different this time around. But what does it tell us as we do start to head into January, as we head into next year? Do you think that momentum will continue?
Yeah, look, I think it will for a short period. I think probably 5,800, maybe inching a little bit closer to 6,000 could be a reasonable target. But I think we sort of ultimately have to have a pullback at some point. It has been, a very rapid rise that we've seen on the ASX 200 in recent months, most notably in the last month. It's almost unsustainable. In fact, I think it is totally unsustainable for the market to continue to rise at the rate that it has. It's starting to look overboard on a couple of technical indicators, the RSI and the stochastic. Not that means that the market has to come crashing back to earth, but I think the market has rallied really in the absence of any bad news and in the absence of any further big macro events. Obviously, the Fed decision was the last one this year. So the markets won't have that clear air into next year. Already everyone's starting to talk about Europe as the next major epicenter of concern in financial markets. We'll have French elections. We've obviously got the ongoing issues with the Italian banks. Not to say that any of these can't be resolved, but after such a strong rise, any wobble at the top tends to see markets pull back a little bit. So in terms of a bit of a market map, like I said, I wouldn't be surprised to see us hit sort of 5,800 in January next year. I think that's when the momentum will perhaps start to change a little bit, will come off a little bit, and it may be into reporting season that is the catalyst for the market to pull back. The market and stock prices re-rate based on fundamentals again.
That was actually going to lead to my next question. What would be the catalyst for a pullback? Because as we know, I mean, there's obviously been so many global macro factors at play, notably China and obviously the US economy recovering well and more stimulus and so forth being pumped in. But it's going to come down to earnings again, isn't it, of course, in 2017, making sure that the earnings momentum continues to justify these relatively high valuations.
100% right, Leanne. I couldn't agree with you more. The great thing about reporting season is it's a leveler. It discards all the noise and all the expectation, and it just comes down to whether or not the companies that make up the index have been able to perform, whether they've outperformed or underperformed, left in the wash-up with a very clear indication of how the market is faring and, of course, how the constituents within the market are faring. So absolutely, like I said, I couldn't agree with you more. It'll absolutely come back to how the results fare in reporting season. If we continue to see strong numbers, well, then there's no reason why the rally can't continue. Just overlaying it again, though, with the macro factors, again, time and again this year we've seen macro events trump anything that's going on locally, trump anything that's going on in terms of individual stocks, and big macro issues have driven the market in one direction or another. So whilst reporting season is important, let's always, of course, be mindful of the fact that there can be global macro events that supersede everything. And, no doubt, like there was this year, there'll be some next year that we haven't even thought of yet.
Yeah, absolutely. Let's, in fact, touch on some of those areas now of the market that you will be watching as we do head into the new year. And I just wanted to start off with commodities, I guess, and the mining space. As we know, there's been a huge comeback over 2016 after those worries that we had at the beginning of the year. But mining services, are you predicting this to make a comeback? I mean, are these commodity prices going to continue to remain well supported?
Yeah, look, I mean, even if commodity prices don't continue to go up from where they currently are, the fact that they have risen so sharply from their lows earlier in the year means that mining companies are likely to increase their capex. Of course, they cut it back so drastically. A lot of mining companies cut back so drastically on their capex, trying to get their balance sheets in order when commodity prices were at their lows. Now they're willing, seemingly to, or I think they will be willing to spend more money on their mines, and that translates hopefully for mining services to do well. A company like Monadelphous, Wally Parsons has already benefited strongly from the comeback in commodity prices. But some of the lesser names like Duet that have continued to struggle, they could get a leg up as those big companies and even some of the mid-tier miners, as I said, increase their capex on the back of the better commodity prices we've seen in the back half of this year.
What about the banking space? Because we know here in Australia, the banking sector has outperformed more broadly, quite strongly. In fact, bond yields rising, regulation looking to be removed to some degree. And then, of course, rising rates in the United States. That should help out the bottom line for a lot of the major banks. What is your view on how we should expect the financial sector, that momentum to continue into next year?
Yeah, look, I think at least in the first half of next year, that the momentum in the banks towards the end of this year should continue, and it's really for me the fact that interest rates are rising and likely to continue to rise at some sort of steady pace next year in the US. That will translate into better bank earnings here. The banks have already used the higher cost of capital as a reason to raise investment property loans. Having two investment properties, I don't like the fact that they've done that, but they have indeed done it. And like I said, they've blamed it on the fact that costs are going up. I don't know how much you buy into or believe that argument. I think it means that they're increasing their margins on their investment loans. Look, they're probably also doing it because they want to stem the property market here in Australia, but undoubtedly they're going to have more room to move, I think, and they'll be able to extract more dollars from both primary residences and investment properties here in Australia.
All right, now just before we finish up, I want to get a thought from you on the healthcare space. We've been looking at an interesting note this morning from Morgan Stanley around some of these health players. Obviously, the weaker Aussie dollar against the US is generally beneficial across the healthcare space, but they are concerned about weakness in the euro having an impact. What is your thought on, I guess, whether we will start to see a recovery in 2017 for those healthcare stocks, and which ones in particular would you be eyeing?
Look, Leanne, I listened with great interest to your cross from the desk earlier this morning talking about exactly that, the effect of the euro and the weakening euro on earnings for Australian healthcare companies. I think it's the back half of 2017 that healthcare companies start to recover. I think some of those currency headwinds will dissipate. Europe will sort itself out in one way or another. And with a clearer picture on exactly what's happening with the US dollar, I don't expect the US dollar strength to continue as it has, say, over the past 12 months. The US dollar has risen exceptionally on the back of everyone expecting that the Fed will do something. Once the Fed starts doing something, you would expect that those expectations aren't as strong because it's a known. It can be factored into models, and we don't get a stronger appreciation in the greenback as we've seen over the last 12 months. So I think it's the back half of 2017 that these healthcare plays can recover. I'm thinking of names like CSL, Cochlear, Ramsay Healthcare, really sort of the top end of town. I think something like a CSL, if it gets into the 80 handle, well, then it's almost an automatic buy. Cochlear, I'm a little bit more circumspect on. They have a bit of a lull in their R&D, 5-year R&D schedule at the moment. Some of their competitors are catching up quite considerably, and I don't think it's until 2018 that they launch their new product. So Cochlear, probably not so much, but certainly CSL, great company, great Australian company that should continue to do well, and Ramsay as well. Like I said, I think some of those bigger names, if they get a little bit weaker from where they are now, I think, like I said, they're almost automatic buys. I think you have to buy them.
All right, fantastic. Really appreciate your time, Chris. It's been wonderful talking, and do hope you have a great Christmas as well. Talk to you in the new year.
Thanks, Leanne. Take care.